Hi, we're going to look at examples of determining the cost of property, plant, and equipment, like the last video talked about definitions, as well as looking at what do you do when you buy a group purchase of property, plant, and equipment. Because usually when you buy a building, you buy the building and anything that is in the building plus the land upon which the building stands. So how do you divvy up the cost between all those different types of property, plant, and equipment because they have useful lives that differ between them? So first off, determining the cost of long-term assets. Here we have a company that purchased land next to its factory to be used as a parking lot, and these were the expenditures they expended in order to not only buy the land but to create that parking lot. And we need to divvy it up between what would go into land, which is not depreciated, and what costs would go into land improvements, which will be depreciated out over the useful life of the parking lot. So the first one is the purchase price of the land, and that goes into the land account. Second, broker's fees, since that has a causal relationship to purchasing the land, it also goes into land. Title search and other fees that have to do with the closing of the land goes into land. And the demolition of a cottage that's on the property, which you needed to clear the land in order to build the parking lot, also is included in the cost of the land because you're getting it ready to be used. And then the general grading of the property, 8400, since it's general grading and not grading specifically for the parking lot, it's included in the cost of the land. So when we debit land in this acquisition, we're going to debit land for $676,800. That's one of the debits. Going on, we see that we paved the parking lots, so that's specific to the parking lot, so it's traceable costs. So that goes into the land improvement or the parking lot. Lights for the parking lot also goes into the parking lot. And the signs for the parking lot also go into it. So we're going to debit land improvements or parking lot for $156,800, and we'd credit cash, accounts payable, or notes payable for the total sum of both the land and the improvement, because those are the costs that you had to incur in order to acquire the land and also improve it to make it a parking lot. All right, here's another one. We purchased a new piece of equipment on January 1st of 2017. The company paid $920,000 for the equipment, also $62,000 for transportation, $10,000 for the insurance while in transit. All of those costs would be included in the cost of the equipment and debited to equipment. The company also estimates that the equipment's useful life will require some additional power, which will cause their utility bills to go up by $90,000. That is a red herring. That has nothing to do with the cost of the equipment. That has to do with its operating expenses. So that would be just utility expense as it is incurred and the utility bill is received. The equipment has a salvage value of $50,000. Now, what is salvage or residual value? That's how much you think you're going to be able to sell or dispose of that piece of equipment at the end of its usefulness or its useful life. So that we don't depreciate below something's salvage or residual value. So let's look at the questions. Part A, what amount should the company capitalize for this equipment? It should capitalize the $992,000, and that includes the equipment, the transportation, and the insurance while in transit. Part B, what is its depreciable base? In other words, how much will you depreciate? Well, we don't depreciate the salvage value, so we are only going to depreciate $942,000, but not the salvage. Part C, what amount will be depreciated over the life of the equipment? The depreciable base, or the cost minus the salvage value, which again is $942,000. All right, now what do we do when we have a lump sum or a group purchase? Generally, you allocate the price between the assets acquired based upon their relative fair market values. And it's up to management to decide what the relative fair market values are, but generally how you do it is you go and get an appraisal of the various components of your purchase, and you allocate accordingly. So let's see how it's done. Well, here we bought a car wash for $480,000, and if purchased separately, the land would have cost $120,000. So notice we're putting in here the fair market values of the land, the building, and the equipment. So the fair market value was $600,000, but notice we only paid $480,000 for it, which is fabulous. We are such a deal maker. So how do we allocate that $480,000 purchase price between the land, the building, and the equipment? You take the fair market value over the sum of the fair market values, or for the land, $120,000 divided by $600,000, and multiply it by the purchase price of $480,000. So the land is going to be allocated $96,000 of the $480,000, and that's what the cost of the land will be recorded at. The building, because it has a fair market value of $270,000 over the sum of all the fair market values of $600,000, the building is going to be allocated $216,000 of the $480,000. So notice we take that ratio times $480,000, and building will be debited for $216,000. Its portion of the purchase price. And equipment, because it's appraised or its fair market value is $210,000, of the total fair market value appraisal of $600,000, it's going to be allocated $168,000 of the purchase cost as its basis going forward. So equipment gets debited for $168,000, and we credit cash or notes or accounts payable for the purchase price, $480,000. So when we have a group purchase, allocate the cost based on the relative fair market values.